Hi, everyone. I'm Mike Pacito with IM Global Partner. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. We believe with DBMF, we've designed for investors, advisors, and allocators the ideal solution for accessing the managed futures category by combining an index plus replication approach and low fees in an elegant, efficient, and effective ETF. I'm joined as always by Andrew Beer, co-founder of Dynamic Beta Investments and co-portfolio manager of DBMF. They'll be touching on January performance, current positioning, and some interesting statistical information about the asset class in general. So let's get to it, Andrew. I'm going to hand it off here to you.
Thank you, Mike, and greetings, everyone. For these monthly updates, we decided to make them a bit shorter than the one last month. I'm hoping to keep this under 10 minutes. So I'm going to spend the time on a few specific charts to highlight some important themes, but the full set of slides will be available if you want to, for instance, dig into current volatility adjusted positioning. So with that, let's jump right in. So it wasn't a great start to the year. In January, we were down about 3% on a price basis, a bit less on an NAV basis. Simply put, we and the managed future space overall were just not well positioned for a rally in risk assets last month. We entered January betting on higher rates and lower equities, and the markets moved the other way. If you look at the box on the upper right, and following the metaphor that managed futures funds try to ride market waves, we've had very, very choppy seas since last fall. There are two widely divergent views on where the economy and markets go from here. One path we call Goldilocks, because here the economy slows enough to dampen inflation, but without a real recession, the Fed declares victory and starts dropping rates by year end, and we quickly go back to the go-go 2010s. That view dominated in January, as you'll see when we look at the asset class returns. The other view, the one held by a lot of macro investors, is that a decade of fiscal and monetary profligacy will take years to unwind, and the ripple effects will cascade through markets. As one smart friend said, you're going to need a lot more than a few Tylenols to shake off that 10-year bender in Ibiza. This all gets more complicated, of course, by the irony that the more ebullient markets are, the more likely inflation stays high. Governments keep throwing money at people, and once again, the Fed will have to pull the pin on the tightening grenade. Managed futures funds are trying to figure out which camp will win. There was a particularly wide divergence in performance last month among funds in the space, which happens when you get these extreme moves in markets. In our portfolio, we're seeing some meaningful rotations as funds pivot out of last year's winners, cut losses on losing positions, and hunt for the next big trade or trades. On the lower right, you can see that we've held our short position in treasuries, probably because the recent drop in yields is still small potatoes compared to what happened over the past year. But we flipped from net short to equities to long and continue to favor non-US developed and emerging markets over the S&P 500. After betting on King Dollar against the yen and euro last year, we got out of the yen short in the fall, which we discussed at length in the last call, and just covered the last of the euro short. We're modestly long both crude oil and gold. So overall, the positioning has gone from crash protection bet on uncontrollable inflation to a much more balanced portfolio today. We have a more detailed slide on this near the end of the deck. Let's turn to the next page, please. So we call this slide Diversification Bang-for-the-Buck. It shows the performance of DBMF since inception versus the S&P 500, Bloomberg Ag, and SocGen CTA Hedge Fund Index. So I want to highlight two themes. First, DBMF has consistently outperformed the SocGen CTA Index since inception. Our track record does extend back a few years before launch, and assuming you're a professional investor, and if you've not done so, I'd encourage you to reach out to Mike to get the full track record. The second theme is that DBMF has had low or negative correlation to both stocks and bonds since inception and significant alpha generation. Most diversifiers have a high correlation to either stocks or bonds, e.g. Private equity obviously will rise and fall with equities over time, and private credit will do the same with more liquid bonds. Hence, stocks and bonds, with stocks and bonds rising and falling together these days, including January, we think this feature is much more valuable today than even a few years ago. Next slide, please. As discussed, I'm going to go quickly over the next two slides. The first is January performance of DBMF, the SocGen CTA Hedge Fund Index, and many other asset classes. It's titled Back to the 2010s ? The version last month was titled Beacon of Green in a Sea of Red, and we left the 2022 figures in just to give you a sense as to how much the markets have shifted direction in the past few months. So one thing I would underscore is stocks and bonds are indeed moving in tandem these days. And there's a growing body of evidence that correlations will remain positive as long as rates stay at these levels, which obviously is a serious problem for any portfolios built around the assumption that bonds would hedge stocks or vice versa. Next slide, please. So here's our volatility adjusted positioning. As noticed, the big moves have been shifting from net short equities to modestly long and covering the euro short. Note how the treasury positioning remains short. From my perch, what this also shows is a much more balanced portfolio than a few months ago. For instance, if markets remain risk on in February, we should make money in equities, but give back some in rates. So a quick comment on that. A lot of people think about managed futures as either getting whipsawed or making a killing. That simplification misses something. There are plenty of markets without a single huge theme like inflation last year, but where guys can make $2 at one trade, give back $1 on another, and still advance the ball in a grinding, yard by yard fashion. I think we'll see plenty of that over the coming years, which on top of the current 4% yield on cash makes me optimistic about the return profile of the fund, even if we don't see a succession of tsunamis. Next slide, please. Mike and I decided to add a bonus slide each month. Sometimes we'll talk about a specific trade like yen or crude oil in last month's presentation. This month, we want to highlight some statistics that we added to the last webinar. So look at the performance data for the SocGen CTA index since 2000. Through year end and over 22 years, the index has delivered 75% of the returns of stocks and 120% that of bonds. So this return statistic surprises a lot of advisors who first learned about the space in the 2010s. So you probably all know about low correlation and crisis alpha, but this is the stat I think that is critical in moving managed futures from a marginal play to a core strategic allocation. So Mike Partners did a very good analysis of the impact of adding managed futures to a portfolio of stocks and bonds. And what you see is that absolute returns don't decline, but risk does by a lot. So that means you can give clients a smoother ride without sacrificing returns, which I think is something we all hope to be able to do. So if you want to see that paper, please let Mike know. As a final matter, I also took some time to write a short white paper on managed futures specifically for the advisor community. We finalized it last week. And it's built not just on our conclusions and judgment about how to build a successful, durable, long-term allocation to space, but also summarize what I've learned from dozens or maybe hundreds of conversations with all of you about your experiences, goals, etc. So if you want a copy, then please connect with Mike or members of the team, and they'll get it to you. So with that, I'll hand it back to Mike.
Thanks, Andrew. So I opened by describing DBMF as elegant, efficient, and effective. This slide tells that story very simply, showcasing the since inception performance of DBMF versus the category average as defined by Morningstar. And while it's not always all about fees, I think Jack Bogle proved pretty convincingly they certainly do matter. In fact, they matter a lot, especially in the managed futures category. And this simple notion is one of the mottos of dynamic beta, that fee reduction is the purest form of alpha, and it's a key characteristic of what makes DBMF unique and compelling. So I'll close here by saying thanks to all of our clients and to our prospective clients for your confidence and interest in DBMF. If you have more questions about the strategy or would like further information or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com. So until next time, from DBI and from iMGP, thanks for spending time with us.